Imagine working your entire life investing in real estate and then deciding that you wanted to sell so that you could purchase something else or reinvest it into something else, but you can't because you are tied with golden handcuffs called capital gains. Well, I have a solution for you that may actually mitigate this issue and allow you to exchange your property and avoid paying capital gains tax. If you own investment properties and you are ready to upsize, downsize, exchange into a different area, or exchange into a different type of property, this video is for you. I'm Shamika Fox, your Santa Cruz real estate expert, and if you are thinking of investing or purchasing or selling right here in the Santa Cruz area, we would love to be your realtor of choice. And if you are considering buying or selling outside of Santa Cruz, please let me know so that I can connect you with another fabulous realtor. If you find this video interesting, entertaining, valuable at all, please hit that like and subscribe button. We're trying to get to 1,000 subscribers by the end of 2025, and every subscription helps. Thank you so much and stay tuned. So what is a 1031 exchange? A 1031 exchange is a tax strategy that allows real estate investors to defer paying capital gains tax on the sale of their investment property, so long as the proceeds are reinvested into a similar property of equal or greater value. The exchange is named after Section 1031 in the U.S. Internal Revenue Code, which outlines the rules and regulations for like-kind exchanges. The key benefit of a 1031 exchange is that it enables investors to defer paying taxes on the gain from the sale, which allows them to reinvest the full amount into a new property and potentially grow their real estate portfolio without immediate tax liabilities. However, there are certain rules when it comes to 1031 exchanges, and we're going to dive into the rules so that you can have a better understanding. But please note, I am not a tax advisor, so if you have specific questions as it pertains to you, please make sure you reach out to your appropriate tax professional. This is just the general overview of what a 1031 exchange looks like. 1031 exchanges are great for real estate investors for many different scenarios. One scenario could be that they want to upgrade to a larger property. So maybe they own a duplex and they want to buy an apartment complex, and they would be allowed to sell their duplex and take their proceeds and reinvest it in the apartment complex. An exchange is allowed as long as you are buying like-kind property, so it has to be of equal or greater value. Another scenario that an exchange would be a great option for real estate investors is to diversify property. Maybe you own a piece of residential real estate that you've been using it as a rental property, and you want to purchase a vacation home that you're going to utilize sometimes, but you're going to rent other times. Now, again, make sure you verify that this is acceptable with regards to the Internal Revenue Services and the tax code. But if you want to diversify your properties and you want to exchange from one property to another, that would be another scenario that a 1031 exchange would work really well for. Another really cool scenario would be maybe you want to relocate your assets. Maybe you own all of your properties right here in Santa Cruz, and all of a sudden your child decides that they want to go to Arizona State University or to University of Miami, and you decide, hey, I've owned these duplexes or multi-residential properties in Santa Cruz, and now my kid wants to go to school on the other side of the country. It would be very beneficial for me to sell the property that I have right here in Santa Cruz and purchase an apartment complex or purchase a multi-residential unit in the area that your child's going to go to school for. It would be a new investment, so maybe you want to reallocate your assets to a different geographic area. Another scenario that would be a good reason why somebody would want to take advantage of a 1031 exchange is maybe they own land such as an office building or retail space or any other type of commercial building that would allow for an increase in rent, and also that's already developed so that you don't have to develop the vacant parcel of land yourself. Another scenario that would be a reason to utilize a 1031 exchange is if you want to consolidate or downsize properties. Let's say you own multiple multi-residential properties and it's just become too hard to manage all of these properties, but instead you want to consolidate and purchase, let's say, like an apartment building. So you could sell your 5 or 6 different duplexes or single family residential properties, and you could purchase an apartment building that could potentially offer more income and also less management. And another scenario that could lend itself nicely for a 1031 exchange is if you want to take advantage of appreciating properties. So deferring taxes on appreciating properties is a really good way to benefit from the property's future growth. However, as with anything with the government, there are rules one must follow in order to take advantage of a 1031 exchange. So listen carefully and make sure that you understand these rules, and not only that you understand these rules, but you actually utilize these rules. I've known many people to sell a property and they've run out of time to name the new property, which you have to do in 45 days or less, and I'm going to go into the rules in a second. And once you run out of time naming your new property or closing on your new property, you lose the ability to do a 1031 exchange. So really make sure that you understand the rules of a 1031 exchange and really make sure that you follow them, because you better bet that the IRS is going to be checking on the details of your exchange. So the rules for a 1031 exchange are as follows. You must name the new property within 45 days of selling your current property, and you must close on the new property within 180 days of selling your current property. You must use what's called a qualified intermediary. Now, the role of a qualified intermediary, or a QI, are as follows. The QI is an independent third party who facilitates the transaction between a buyer and a seller. So if you are a seller and you are selling your property to a buyer, it is important to include in the purchase agreement or the contract with the buyer that the buyer agrees at no cost to buyer to participate in a 1031 exchange. As with when you choose a realtor, it is important that you choose a qualified intermediary who you trust. This person's role is crucial in ensuring that you are going to be able to take advantage of your 1031 exchange. The role of the qualified intermediary are as follows. They hold the proceeds. So once you sell your property that you're exchanging out of, they collect the proceeds and they hold them prior to disbursement. If those proceeds ever touch your bank account, you could be liable for the taxes that incurred on your capital gains. They facilitate the process. So they will take care of not only holding the proceeds, they'll make sure that you're on time with regards to naming the property in 45 days and closing in 180 days. So you want to make sure that your escrow and title company are connected with your qualified intermediary, because they will need to coordinate a lot of details to, again, make sure that you can take advantage of a 1031 exchange and not end up owing capital gains tax. Another job of the QI is executing the proper documents. They will have all the documentation that is needed in order to facilitate the 1031 exchange, and that is the QI's job, is to make sure that all the proper documentation is taken care of for that 1031 exchange. And another job of the QI, and the final job of the QI, is to ensure that you are meeting all of the regulations and compliance issues that could come up in a 1031 exchange. Again, you really need to make sure that you choose somebody that you trust, because if any of these steps are not done appropriately, you could be liable for your capital gains tax bill, and you do not want that if you are attempting to do a 1031 exchange. We talked a little bit about what qualifies for a 1031 exchange, but let me just highlight that piece again, because I think that's a bit of important information. So the properties that would qualify for a 1031 exchange are investment properties. So it cannot be your primary residence that you're currently living in. However, if you have purchased your home as your primary residence and then you moved out of your home and you rented it out for 2 of the last 5 years, it would then be considered an investment property, and your primary residence then could qualify for a 1031 exchange. But make sure that you understand that caveat explicitly so that you are not liable for the capital gains tax. Another important rule that we talked about is that, and maybe the most important rule, is that the properties being exchanged must be like-kind properties. That doesn't mean they have to be exact, but for example, if you're selling, like we said, your primary residence that you've been using the last 2 years for a rental, and you are exchanging it into a multi-residential property, that would be acceptable. But if you're exchanging your primary residence for a commercial building, that might not be acceptable. So again, make sure that you consult a 1031 exchange professional as well as a tax professional so that they can appropriately guide you. Here are some examples. A single-family rental property can be exchanged for a multi-family property. Land can be exchanged for a commercial building. An office building can be exchanged for a shopping center. So those are essentially like-kind properties, and really make sure that you understand what the definition of like-kind properties are when you are trying to facilitate a 1031 exchange for yourself. Both properties must be used for investment purposes. Again, that means that you're not living in the home and selling it. Investment or business use, both the relinquished property and the replacement property must be used for investment or business purposes. Properties held for personal use, such as your primary residence, a second home, or a vacation home, generally do not qualify unless specific conditions are met, like you're renting the property for a certain period. So again, I talked about vacation homes. If you own a vacation home and you rent it for a certain period, and make sure you know what that period is, you could potentially use your vacation home to exchange into another like-kind property and facilitate that through a 1031 exchange. It must be real property. So 1031 exchanges are based on real property. So for example, you cannot sell your multi-unit complex and go purchase a new Ferrari or Maserati. It has to be real property. And then again, it must be of equal or greater value. So if you sell your investment for $1 million, then you have to reinvest in something that's $1 million or more. That said, you can diversify. So if you sell your property for $1 million and the property that you want to exchange into is only $500,000 because you're buying in a different area that's less expensive, you can still accomplish that, but you will have to invest the other $500,000 into another piece of investment. So remember, if you want to exchange out of your primary residence, you need to make sure that it was also used as an investment property. You were not living in it exclusively. Understand that rule. And if you want to sell a vacation property or a vacation home, make sure you understand the requirements that you need to meet in order for that vacation home to be considered an investment property. A 1031 exchange is specific to investment property sales. So a key takeaway is the rule of 2 of the last 5 years. If you have not lived in your home for 2 of the last 5 years and you are collecting an income because you rented it out, then that property could be considered an investment property, and you have the possibility or potential of selling and reinvesting through a 1031 exchange with your primary residence. Again, you need to verify this with a tax professional. If you find this information valuable, please hit that like and subscribe button. We're trying to get to 1,000 subscribers by the end of 2025, and every time you hit the like and subscribe button, it helps me get that goal. There are different types of 1031 exchanges. As I mentioned, the most common is you sell a property and then you reinvest in another property within your certain time frame that's allocated to name the property and close on the property. That said, it can be a little complicated, especially if you're investing here in Santa Cruz, because finding a replacement property with the limited inventory that we have might not be as easy as it sounds. So if that type of an exchange does not fit your parameters, there are other options and opportunities for you to still be able to execute a 1031 exchange and meet the requirements. A simultaneous exchange is where the sale of your current property and the purchase of your new property happen simultaneously on the same day. So if you are able to close both deals, both transactions simultaneously, that is a simultaneous exchange. A simultaneous exchange is ideal for investors who have already identified their replacement property and already have a buyer for their current property in place. Otherwise, you're going to be jumping through a bunch of hoops and you're going to be trying to coordinate the timeline, and it really won't work unless you have both of those pieces in place already. So simultaneous exchange means that you're closing both properties on the same day. If you don't have all of your pieces or your ducks in a row and you can't do a simultaneous exchange, there's something called a delayed exchange. And what a delayed exchange is actually the most common type of 1031 exchange, but you have to make sure that you hit those timelines, because if you miss those timelines, you could be liable for the capital gains tax. How it works. The process begins when you sell your current investment property. The proceeds from the sale are held by the QI, or the qualified intermediary, which is required by IRS rules. You cannot take possession of the proceeds directly. I've spoken about that before. If the proceeds from the sale of your property hit your bank account, you will be liable for taxes. Don't let that happen. Hire a QI so that they can manage the proceeds and reinvest them into your exchange property. Identification of your replacement property. After the sale, you have 45 days to identify your replacement property. Now, let's say that you have identified your replacement property, but you only have one replacement property identified, and your offer is accepted, and you have started your escrow process, and you have realized that the property is not going to be what you expect it to be. Either its income and assets do not meet what you need them to be in order for it to be a wise investment, or the roof is completely failed and the foundation has failed, and it's going to take more money than you have set aside for this particular project. A lot of investors and sellers do not like this because it jeopardizes the sale of their property, but a lot of investors will actually write offers on multiple properties simultaneously, specifically so that if one of their properties that they're in escrow on does not work out, they have an alternative to fall back on, which allows them to meet the timeframes. Because if you miss your 45-day naming of the property and your 180-day closing of the property, you could be liable for tax liabilities. So a delayed 1031 exchange offers more flexibility to the investor as far as time and flexibility with regards to identifying and closing on their replacement property. Another type of 1031 exchange is a reverse exchange. Now, I mentioned a little bit earlier that sometimes if you're investing in a place like Santa Cruz and our inventory is so limited, it may be beneficial to do a reverse exchange. And a reverse exchange is exactly what it sounds like. A reverse exchange is when you purchase the property that you will be utilizing in the 1031 exchange prior to selling your current property. It is used by investors when inventory is limited or the market is competitive. It is used by investors when there is market uncertainty, and it is used by investors if you need to secure financing. So let's say that you're only going to cash out $500,000 of your investment, and the new property that you are purchasing is going to require a loan for $1 million. Then a reverse exchange would be helpful or beneficial because your time doesn't start until after you close on the purchase of the replacement property. And in this market, our market is still moving, but it's just moving a little bit slower, and it's just a bit more even playing field as far as buyers and sellers go, especially with regards to investment properties. The last type of exchange that we're going to talk about today is an improvement exchange. An improvement exchange defers taxes by improving properties. An improvement exchange, also known as a construction 1031 exchange, is a type of 1031 exchange that allows investors to defer taxes by using the proceeds from the sale of a property to improve or renovate a replacement property. In this exchange, the investor reinvests the funds into both the purchase of the replacement property and any necessary improvements, increasing the value of the property while deferring capital gains taxes. How it works. Sale of the relinquished property. The investor sells their investment property, the relinquished property, and places the proceeds into a qualified intermediary account, or a QI, as is required in any 1031 exchange. Remember, we've talked about the QI many times now. Make sure you hire somebody you trust. The investor must identify and acquire a replacement property within the normal 1031 exchange timelines. So they've sold their property. Now they have to identify a property within 45 days and close in 180 days. Now here's where it gets different. Now this is why it's called an improvement exchange. Now up until now, it's been the same as a simultaneous exchange or a delayed exchange or even a reverse exchange, that we've sold a property, we're purchasing another one, we've named it within 45 days, and we're closing within 180 days. Now, in an improvement exchange, the investor uses the proceeds to purchase the replacement property and then uses additional funds to make improvements on that property. The improvements could be anything. It could be, like I was talking about, new foundation, roof work. It could be remodeling the house so that when they rent it out, they could fetch more rent. Renovating a building. So if you buy a commercial building and you have a tenant that's going to be moving in and it was retail and now it's going to be a restaurant, you could use it for tenant improvements. Usually, though speaking, the business pays for tenant improvements, so don't offer too much as a generous, gracious landlord. So an improvement exchange, again, is very similar to all the other types of exchanges, But the last piece of the puzzle is that they can set aside some of the proceeds in order to reinvest in the property. So if they sell their property for $1 million and the new property they purchase is $800,000, they would have $200,000 that they could reinvest in the property, maybe to remodel it, fix it, add another unit to the property, something of that nature. That's called an improvement exchange, and it does fall into the category of a 1031 exchange. Time for a commercial break. If you have found value in this video, please hit that like and subscribe button. We're trying to get to 1,000 subscribers by the end of 2025. And if you are considering buying or selling right here in Santa Cruz, we would love to be the realtor that you choose to work with. And if you are looking to buy or sell out of the area, fill out the form below and I'll connect you with another fabulous realtor who will take exceptional care of you. Now, with any type of possible tax deferral or government involvement or bureaucracy, there are rules, and so you must make sure you follow and abide those rules so that you don't get hit with a capital gains tax bill that you were not expecting because you intended but didn't do it correctly to do a 1031 exchange. So let's talk about the pitfalls that could potentially derail your 1031 exchange and cost you a lot of money, because we don't want this exchange to cost you a lot of money. A major pitfall, and I've seen this before, is missing the deadline. Remember, you have 45 days to name your replacement property and 180 days to close. A lot of investors who are participating in 1031 exchanges will identify multiple properties, get their offer accepted, and then make the decision on which property to close on once they get closer to the deadline of closing, so that they're not buying all the properties that they've written offers on. They're identifying multiple properties so that they're protected, and then they're closing on only one or maybe two of them, depending on what their exchange dollar amount is for. Another pitfall is not working with a qualified intermediary. You must work with a QI. The QI holds the proceeds. They take care of paperwork. They make sure that you are in compliance with the rules with regards to the IRS. They make sure that the funds are appropriately distributed to the replacement property. If those funds hit your bank account before you close escrow on your replacement property, you could be liable for the full capital gains tax consequences. So make sure that you have a qualified intermediary who is holding your proceeds and ready to distribute upon the close of your new property. Another pitfall that could potentially affect you in your tax deferral strategy in a 1031 exchange is overlooking the impact of depreciation recapture. Depreciation recapture is the portion of the gain on a property sale that reflects the depreciation deductions you've taken over the years. When you sell a property, the IRS may require you to recapture the depreciation taken, and it could be taxed at a higher rate than regular capital gains. While a 1031 exchange defers capital gains tax, it does not eliminate the depreciation recapture. So how can you avoid this? Talk to a tax professional. Make sure you have all the information with regards to depreciation recapture. You need to understand this, they need to understand it, and you need to make sure that you have it documented. Keep track of your property's depreciation schedule. Another pitfall that could possibly derail your 1031 exchange and cost you a lot of money in tax liability is not identifying the correct number of replacement properties. The IRS has strict rules about how many replacement properties you can identify within the 45-day identification period. While you can identify up to 3 properties without restriction, there are additional rules if you identify more than 3. So how can you avoid this pitfall? Be mindful of the IRS identification rules. If you identify more than 3 properties, make sure their combined fair market value does not exceed 200% of the value of the relinquished property. Work with your qualified intermediary and your real estate advisor, that would be me, to ensure compliance with these rules. Another pitfall of the 1031 exchange rule, which could mean you lose out on your deferred taxes, is failing to follow the like-kind rule. I gave examples of like-kind properties earlier in this video, but make sure you understand how to identify a like-kind property. We don't want you exchanging from one property to another property, and the IRS does not qualify it as a like-kind exchange. So make sure you understand what is considered to be a like-kind property. Another pitfall, and I know you're not going to do this because I already told you it has to be a real property investment, but another pitfall is you close on your investment property. You put the money into your bank account and then you use those proceeds for personal expenses. Maybe you want to go on a vacation. Maybe you've had an eye on that brand new Rolex or brand new Porsche Roadster, whatever, or a diamond necklace. I don't care. Do not do it. Use your QI. Have them hold your proceeds. Those proceeds need to go directly into your new investment, not a personal investment, a real property investment. Okay, I think I made that part clear. Another pitfall, and I want you to be very well aware, especially if you are doing a reverse exchange, is overestimating the value of your replacement property. So why is this important? Because remember, it has to be of equal or greater value. Let's say you're selling an apartment complex in Fresno, and the apartment complex is worth $2 million. And you're buying a beach home here in Santa Cruz that you're going to use as an investment property. And it's a gorgeous beach home. I mean, it is stunning, but it doesn't have a view. It's 2 blocks from the beach. You think it's worth $2.5 million. You get an escrow, and then you have it appraised because you're getting a loan, and the appraisal comes in at $1,800,000. You will potentially receive a tax bill because you have overestimated your replacement value. Your replacement property has to be equal or greater than the property in which you are selling. Got it? Okay. Another pitfall of a 1031 exchange is not appropriately understanding boot. So what is boot? Boot refers to any non-like-kind property or cash received in the exchange. Boot is taxable and may arise if the investor receives cash, debt relief, or other non-qualifying property. So for example, let's say you're selling a auto body shop and you are purchasing an office building. If you include in the sale the tools that you have at the auto body shop and they pay you cash for that, that is not a part of the exchange. That is selling personal property for cash, and you will be taxed on that. So make sure that you talk to your appropriate tax advisor so that you understand completely what you are selling, what you are using in regards to the exchange, and what is going to be taxable income based on the sale of personal property, etc. So understand the impact of boot. I like that. Another major pitfall, and I see this often, is the misunderstanding of like-kind property. So again, we've talked about trading from a single-family residential property that you've been using as a rental into a duplex or a multi-residential property. That's like-kind property. We've talked about being able to sell vacant land and purchasing commercial space. We've talked about selling retail and purchasing office space, apartment complex, etc. Make sure that you understand what constitutes a like-kind in exchange so that you do not sell one property and expect to purchase another kind of property and find out that it does not actually qualify because it is not like-kind. Okay, so those are the pitfalls of doing a 1031 exchange that I really want you to focus on and be very, very hyper diligent and aware of, because if you miss any of them, it could really screw up your exchange and cost you a lot of money. If you are considering buying or selling here in Santa Cruz, please reach out to me. I would love to be your realtor of choice. And if you are considering buying or selling outside of the area, reach out to me because I would love to connect you with another exceptional realtor. Let's say that you are ready to retire and you do not want to manage any more real estate, but you have an exchange opportunity and you want to take advantage of it because, again, not paying taxes is better than paying taxes, in my humble opinion. Are there alternatives to doing a strict 1031 exchange? And the answer is yes. Here are your alternative options. And again, I'm going to say this, make sure you consult with your tax professional. I am not a tax advisor, I'm just a realtor. That said, there are a few different 1031 exchange alternatives. So here we go. While a 1031 exchange is one of the most well-known tax-deferred strategies for real estate investors, there are several alternatives that can also help defer taxes, diversify investments, and grow your wealth. These alternatives include a 721 exchange, REITs or real estate investment trusts, and tax-deferred retirement accounts. What is a 721 exchange? A 721 exchange or UPREIT allows investors to defer capital gains taxes by exchanging their real estate for shares in a real estate investment trust or REIT. Unlike the 1031 exchange, a 721 exchange allows an investor to convert their real estate into a more liquid investment or shares in the REIT while still benefiting from tax deferral. So how does it work? The investor exchanges their real estate for shares in the REIT, typically in the form of an umbrella partnership REIT. The exchange allows the investor to defer capital gains tax. Ownership in a REIT, once the exchange is complete, the investor owns shares in the REIT, which allows them to receive dividends and benefits from the REIT portfolio. Again, the benefit of doing something like this is maybe you're just really tired from managing real property for your life. This would allow you to reinvest in another type of real estate investment, but it's a little bit more hands-off. You don't actually have to manage the property. It's a portfolio investment, and then the person who manages the REITs will manage the property, and then you will benefit financially from those investments. So that was 721 exchange or an UPREIT. Now, a traditional REIT or a real estate investment trust is a company that owns, operates, or finances income-producing real estate. REITs allow investors to buy shares in real estate portfolios without directly owning or managing the properties. REITs provide a more passive way to invest in real estate with the added benefit of receiving income through dividends. So just like the 721, you're selling a property, you're investing it in an investment, and then somebody else is managing the real property for you. And then lastly, another alternative to a 1031 exchange is investing in a tax-deferred retirement account such as a 401k or an IRA. Again, please talk to your tax professional and your financial planner or advisor to make sure that whatever solution to your 1031 exchange you choose is going to be what you expect and it's going to benefit you financially. Because again, after all, that is what we are trying to do here, is benefit financially through our investments. Tax-deferred retirement accounts like traditional IRAs and 401ks allow investors to defer taxes on income and gains until they withdraw the funds in the retirement. The tax-deferred growth can be a powerful way to build wealth over time, and it can also be used to invest in real estate. So if you choose not to do a 1031 exchange, but sell your investment property and reinvest it in one of these categories that we just discussed, please make sure you understand the specific implications of the choice that you make. Make sure that you consult an appropriate tax professional, an appropriate financial advisor and planner, and make sure that you understand what the implications will be to your finances. So to recap, a 1031 exchange is when you sell an investment property and you reinvest your proceeds into a new investment property. It has to be of like kind and it has to be of equal or greater value. And you have 45 days to name the property and 180 days to close. Those are the basic overviews. There are alternatives to a 1031 exchange that we discussed in this video. If you haven't watched the full video, please make sure you watch the full video because this video is a really great way to save you on capital gains taxes if you are investing. We talk about different types of properties that would qualify for a 1031 exchange. We talk about how you can and if you can use a primary or personal residence and or your vacation home in a 1031 exchange. We go into all those details so that we can try and save you money and build your wealth with regards to your investment properties. If you have found value in this video and would like to watch more of the videos that we produce, please hit that like and subscribe button. I am trying to get to 1,000 subscribers by the end of 2025, and every time you hit that subscribe button, it helps me reach that goal. If you are looking to buy or sell in the Santa Cruz area, I would love to be your realtor of choice. And if you are looking to buy or sell in any area outside of Santa Cruz, please reach out to me. I have an amazing network of wonderfully qualified real estate professionals that I would love to connect you with. I think that's a wrap. But before we go, I'm Shamika Fox, your Santa Cruz real estate expert. And until next time, I hope you have an amazing, beautiful, lovely, fun-filled day full of real estate knowledge, wisdom, and investments.